Hi, good evening. Today we have got Manpreet Gill, our head of fixed income, currency and commodities, to give a short brief snippet about her global views. Hi Manpreet.
Thanks, Vinay.
Trade tensions have been on a rise in 2018. What are the implications you see of the US-China trade war and how does it impact emerging assets?
So I think trade tensions, look, they're not one of our baseline scenarios, but it is one of the top risks that we're following. If you step back and assume for a moment if this really does escalate than what we're expecting, I guess the traditional approach is to think of that as it could represent a growth shock to the global economy. And for a financial market, of course, you couldn't rule out a short period of risk aversion. But I think when you look beyond just the US and China, you're talking about emerging economies like India or other emerging markets, the impact isn't as straightforward. The reality is the US consumer is still going to buy. And if Chinese goods become that much more expensive, potentially some of the demand could end up being reallocated to other emerging markets and even to markets like India. So I think that's one area where, if anything, there is the risk of upside actually, as opposed to just thinking about the downside. The second factor, of course, is that in India, ultimately is a much more domestic demand-driven economy compared to many other emerging markets. So if the global environment is going to get a little more rocky, India may actually end up being a good place to be.